Hello, everyone. Welcome to another episode of Test, Optimize, and Scale. Very excited to have Chris Lustrino, founder and CEO of KingsCrowd, with us today.
Hey, thanks for having me.
Chris, it has been a very exciting year for equity crowdfunding here in 2020. Looking at projections for December, and on your platform specifically, we research it constantly. So again, highly relevant and an episode we've been looking forward to. You've been on our wish list for a while. So thanks for being on the show. And could you tell us a bit about your history, everything you've done to get to this stage today?
Yeah, absolutely. Well, Jason, first off, thank you very, very much for having me. I'm a big fan of what you and the team at DNA are doing. I think you've done some wonderful work. And it's so important that as this kind of online private market ecosystem continues to grow, that we have the infrastructure plays of companies like yourself really supporting the issuers and building up this space. So I think it is so incredibly important, and I'm really excited about where we're all headed in 2021. As for myself, I'm founder and CEO of KingsCrowd, as you mentioned. You could very much think of us as kind of the first Morningstar, Bloomberg-esque rating and analytics service for the online private market ecosystem. So if you are a fan of regulation crowdfunding in any way, shape, or form, we rate and analyze literally every company that raises across every platform out there, be it Republic, WeFunder, Net Capital, SeedInvest, and so on. We are the kind of first entrusted rating analytics service for this space. And we're really excited to be able to help investors make informed investment decisions in this market.
Excellent. Excellent. And again, we're using the metrics on a daily basis. I know a lot of issuers and portals reference it constantly. How did you first get involved in equity crowdfunding? What pointed you in this direction?
Yeah, it's a great question. You know, it came from a problem I had in my own life, which is I was working in private equity consulting. I was working on behalf of private equity shops back in 2014, doing all of the diligence for the deals they were going to do, and getting very upset at the fact that I couldn't invest in those deals. And literally, you know, while I was at my job, Googling around and saying, why can't I invest in the private markets, and learning about the Jobs Act, and recognizing, wow, there's this huge opportunity if we bring retail investors and non-accredited investors into this universe. A, it's a new source of capital for founders, but B, for investors, it's an opportunity to invest in a very high growth asset class. But as I kind of sat there and watched the market develop, what we kind of saw was that we had this plethora of marketplaces coming into the space. But if we think about what actually drives decision making in the traditional public equity markets, it's all of the resources that you subscribe to, right? Your Wall Street journals, your Bloombergs, your Morningstars, all of these tools and resources that are around the marketplaces that actually get people to take action. So it seemed like a pretty big market gap. And frankly, it was just because the market was so immature and young. And so we said, well, if we're going to see this market move upstream, we're going to need to provide the resources and tools that people are used to in the public equity markets. And that was kind of the inspiration to do it.
Excellent. Excellent. Now, was Reg CF already in effect at that point? Were we talking about Reg D and accredited investors still?
Great question. So we started in May of 2018. So Reg CF was fully in effect. We had seen the market, begin to play out. We knew there was a demand for it, but also recognized that we needed to start to take the industry forward. And one of the things I'll note is we've started in Reg CF because it was the perfect kind of breeding ground to prove out that there's demand for a service like this. But if we do our jobs well, the kind of equity crowdfunding ecosystem, I think will eventually kind of be known as the online private market ecosystem. And that'll include Reg CF, Reg A+, Reg D 506C, late stage secondaries, really help people understand that there's a pre-seed to pre-IPO market that now exists online in a way that it just never existed before.
And that seems like perfect timing. We got involved in 2014 working on Reg D campaigns, leveraging audience data in ad tech. My background was in that before starting on the agency, put some strong numbers on the board, but was in a constant conversation of this is what equity crowdfunding is. And no one had an understanding. Even on the reward side, talking about kickstarting Indiegogo, there was a gap. So being able to see more adoption at this point, being able to see Reg CF finally come into effect in 2016, which we were waiting for a while, then the increases to the limit and all the discussions that are happening about that right now and projected in 2021 coming to life has really been what looks like as a tool to a larger familiarity from retail audiences. Have you seen different forces to that? I know you guys are focusing on the investor side itself. What do you think have been the biggest bridges to that awareness stage for retail investors, since 2018?
Yeah, it's definitely a myriad of factors that I think have driven the market forward. One of them is that financial services is a slow adoption market, right? We've been talking about fintech banks for 15 years, but only now are we actually starting to see every bank actually have mobile apps that aren't terrible. It takes time for people to adopt new behaviors when it comes to financial services. And of course, venture capital and private equity is kind of the last frontier, right? It's really the last thing we haven't touched whatsoever from a technological perspective. And that's because it is such a kind of old school system. It is something that's been very institutionally driven in the past. And so ushering in a brand new asset class to millions of retail investors, it's a huge leap. And so it's amazing to me. One of the things that really kind of shocked me that I wasn't expecting when the market started was that people invest in Indiegogo and all of these, kind of rewards-based crowdfunding all the time. And they don't think anything of it to throw $100, a few $100s at these rewards programs. But when we said, hey, we're actually going to allow you to own equity in that company, they kind of got scared. It was like, you're offering me a better deal, but there's fear here because why? Why are you offering me this? And so there was just a lot of market discomfort. And
Yes.
all of that comes back to the fact that we need more education. We need to teach people. We need to help them understand the asset class. And we need to build tools like KingsCrowd. And you need, individuals like yourself and your company putting out the word about what is going on in this space, why it's okay to invest small amounts of your dollars into this asset class, why if you diversify, you could reduce your risk. Teach them about all of the factors of startup investing that matter so it begins to become a part of their conversation. And I think what we're seeing playing out is that the marketplaces have done a wonderful job of being careful and being diligent and listing these companies and trying to do as many right things as they can. And what we've seen is that people have had a nice experience, right? There's been good returns for some investors. And oftentimes there's just been a good experience. And so people are becoming more comfortable with this idea. And we're starting to hear from the major institutions, the biggest financial services firms in the country are now beginning to talk about implementing retail investor products along the private equity lines. And I think everyone kind of sees it as that next frontier. And as we get more and more comfort, it's just a snowball effect. More people hear about it and it becomes mainstream. Now, the one other thing that I would say has been a huge driver, and it seems like it's kind of the way of COVID. It's either you're a huge winner or a huge loser because of COVID. And by loser, I mean, really struggling, right? The restaurants, things like that are really taking a massive, massive hit. Now, on the fortunate side, whatever you want to say, there's no good way about it. The online private markets have thrived because of it, because it's forcing change behavior. Just like e-commerce is seeing a 5-year leap into the future where they thought they'd be, we're seeing the same thing with this. Suddenly, overnight, we saw this doubling of the Reg CF market, doubling of the A+ market, because people were stuck at home because deals couldn't be done offline. Yes. And so it's really driven adoption and acceptance that the future is here, and it's here now rather than in 5 years. So it's pretty incredible to watch.
Oh yeah, and I saw it happen firsthand. I was leading a workshop at an accelerator here in Santa Monica the first week of March, and talking about marketing, 3 days. They're setting up investor meetings. Later that week, what was it, South by Southwest, some of the conferences started putting in cancellations. I think Facebook at the end of that week said they were sending everyone to work remote. And the groups in the cohort were getting emails back saying, hey, we have to reschedule our investor meeting. Hey, we're not deploying capital for the foreseeable future. There was a lot of fear occurring there. Meanwhile, later in March, and actually did a webinar with WeFund at the beginning of April, and they had talked about what they saw in terms of returns in March. And we've basically, following your platform, seen month over month growth since. I know it's slightly lower in November, but I think it's going to be, based on projections, much further in December. But just following that storyline, and I like how you said, big winners, one way or the other in terms of which direction companies are going. I also like how you pointed out the investor trust, where at first, a lot of the internet, people don't believe when they see on the first visit. Being able to showcase social proof, third-party validation. You talk about all these different groups in the industry and larger financial verticals that are now getting involved. All of that leading to getting more investors involved. I picture a world where the companies that as a consumer I'm purchasing from, I'm frequenting, I can be a shareholder in, which there would be limitations for the majority of individuals in more historical private equity structures. That's what I see becoming available in equity crowdfunding. That's what I see in our marketing campaigns and the audiences that are getting involved. And would actually like to ask you a question about that, as you guys are so focused on the investor. There's all types of success stories with issuers. I'm looking for more and more success stories of investors, and you mentioned there's been some good returns already, but I want to start with the question of why. In your perspective, why are retail investors participating? Why are they putting in a $500,000 average investment on these Reg CFs? Are they looking to get an early stage to public marketplace type of exit event, and on that smaller amount? Is it more of an experience type of situation where they want to have ownership in a company that reflects different headlines they're seeing on Business Insider, Forbes, TechCrunch that day? Why do you think retail investors are paying attention and getting involved today?
Yeah, so I'll start with I think the broadest market force, and then I'll work down to kind of who our customer is and what we're seeing. So it's interesting, over the past 12, 18 months, we've had a lot of inbound requests from wealth advisory groups, family offices, RIAs, and they all tell us the same story. Our clientele are getting younger. They care about things like ESG and social impact, and they clearly tell us they want to be in things that are different from what their parents are in. And so the way to differentiate is to think about direct deal flow in the startup space, where there's way more ESG, where there's way more social impact. That's where all of the exciting innovation is happening. And there's a recognition that up until now, there wasn't a lot of access to that, but suddenly there is. And so I think that, general desire from a younger investor wanting things around social impact and clean energy and, all of these things are playing a real vital role in supporting what startup investing is all about. It's about innovation. It's about ESG. It supports that thesis. So that's one component. It's just these general market factors of a younger investor caring about those things. Now, in terms of who our user is today, it's kind of interesting to see. I think people thought when we opened the floodgates, everyone would come rushing in, and that really hasn't been the case. What we have seen is that our typical user makes $100,000 to $250,000 on a yearly basis. They're a pretty savvy financial investor. They've typically made 15 investments in this market and have $12,000 to $15,000 worth of investments in their portfolio of startups. And so what that tells us is that these individuals are very intelligent, very capable. They know the markets, they're investing in the public markets, and they've been eyeing this market and thinking there's a real opportunity if I can invest in startups, but they still didn't meet the threshold of being accredited. Mm-hmm. Now suddenly the opportunity is open because they can be non-accredited. And we kind of call them the new angel investor, right? They're the ones who have been waiting on the sidelines, always had the capability to think through and know how to invest in startups, but didn't have the ability to do so. So I think, by democratizing this market and making it an open and accessible system, we're just seeing that pent-up demand starting to come into the space. Now, the next step that we do need to take, though, is getting a more general retail investor to partake, because this is the perfect market where it's about fundamental investing. It's making 10, 20, or 30 investments in companies you believe in the thesis of for the next 10 or 15 years, and then letting it ride and seeing what happens.
Perfect outline. Going to be reviewing those notes with my team. We do so much market audience research, so that depicts things in a very clear way. And again, and for the listeners, because of how much data you guys have, because of your direct perspective on all of these different deals that are taking place. And how do you picture things growing in 2021? Looking at your count, I think you're in 480 or so live deals today here in mid-December. Where do you picture things in December 2021? Monthly raise amounts. I know we're at about 21 million per month given November. Do we see that doubling? Do we see some type of growth metrics in that fashion? Is that something you guys have blueprinted out at all?
Yeah, so I kind of see a world by the end of next year. I would imagine we're approaching, 50 million a month in investment. And it would not surprise me if 2022 or 2023 becomes the first $1 billion year in Reg CF. And a very simple way to think about it is like any universe, right? Whether it be venture capital or the online private markets, there is a limited set of the best deals, the most exciting deals, the ones everyone wants to be in. And to date, once that company hits $1 million under the Reg CF threshold, that's it. You can't invest anymore. And I can't tell you how many times we get like angry inbound requests to us when we're not even the marketplace, just like, why can't I get into this company? And it's like, they sold out too quick. Like, I don't know what to tell you. So I do think we'll start to see more of those companies approach that $5 million investment amount. And people aren't just saying, well, I can't get into that, so I'm just going to go and invest willy-nilly in another deal. They're waiting for the deals they want. So I do think the winners will have much bigger wins, 5 times the size of wins that they're getting today. I think that's a big part of it. The other thing that I think will really drive a lot of this movement is the fact that more Series A companies will come into this space. So there was 2 things holding companies back. It was the fact that they couldn't raise so much money, so it wouldn't necessarily be worth their while for a Series A. And the second thing was they couldn't use a special purpose vehicle and kind of round everyone up into one entity to manage lots of investors in a more simplistic way. Now that's going to exist as well because of regulations. So because of that, the 2 biggest hindrances to getting really amazing companies coming into the space was those 2 things. And they're now wiped out. So it's going to be really interesting. We've already seen the deal flow just skyrocket during COVID. I think we're going to see even more of that. And lastly, we've heard from a lot of VCs that they're becoming more comfortable with both funding companies on these portals and also telling their companies, hey, after you raise with us, you might want to go and do this as part of your capital raising strategy. So there's just a growing comfort that's occurring too. And I think all of those market forces of investors, issuers, and venture capitalists will really drive this market up.
Absolutely. And those extensions and being able to have an anchor investor, a lead investor participate in saying, hey, go take it to this platform now. The portals are so valuable in terms of amplifying those deals. Some of them are coming up on a million investors, 800,000 plus investors that have participated in deals directly on their platforms. So being able to have a blast, an announcement going to those individuals who are historical equity crowdfunding investors, such a new term to say, it is just a great way to be able to stimulate additional retail investors. There's power in the crowd. We're seeing the retail investors come on board as ambassadors, frequent customers, clients, and just sharing as they have a closer connection to everything. So yes, I definitely see that. I've seen the quality of deal flow increase and the industries that it's attracting this year based on the shutdown elements, based on more validity in the industry as a whole, are definitely increasing. Hearing more talks about the type of companies that are going to be doing Reg A Plus campaigns moving forward as well too, and some of the vehicles they're going to be using, real marketing funnels and endorsements and different types of elements to make the campaigns even more widely accepted is going to be interesting to watch. So appreciate all the insights there. Have had a lot of different groups on the show, but some of the technicalities you're mentioning go beyond the discussion points we've had thus far. And you guys have done some of your own capital raises, if I'm not mistaken, as well.
Yes, some, if not all, right? So to date, we've raised $1.5 million from 2,100 investors who own about a quarter of our company. We've done that across Net Capital. We've done a few rounds on Net Capital, and we've also done a round on Start Engine, and more to come in the future. We love utilizing the platforms, and I mean, who better to use it than us? If we don't use it, who should use it? So we're huge believers in utilizing this mechanism to raise our capital, and it's been pretty cool to see. We have, people I grew up with who have thrown in $100, and we have individuals who created billion-dollar companies who've thrown in $150,000. And everything kind of in between. So it's pretty cool to watch.
Sure. And, speaking to the title of the show, philosophy towards marketing, there's some different things that you tested right out of the gate. Did those things work? You had mentioned first degree connections there. Were there other marketing channels or different tactics that you tested out with the portal right out of the gate? It was already in the plans when you guys rolled out the offering?
I always tell people when you go and do these offerings, it's not if you build it, they will come. It's if you build it and then you market the heck out of it across every angle that you can, hopefully they will come. You have to still put in the work. This is not a just turn it on and get money. And so for me, it was definitely a few things. The first degree connections was huge. That was a great start. because I think what a lot of investors are looking for, and we hear this all the time from our users, they look for momentum in the deal. They want to see that dollars are being raised. They want to see that the founder can bring dollars to the deal because it kind of legitimizes it. It shows that they're putting their own back behind it and making it happen, and they can get people very close to them to believe in them. Because if the people really close to them don't believe in them, who should?
Right.
So that was one element. It definitely helped us kind of get off the ground and get going. The other big thing I did was PR. So meeting with local tech publications, trying to get in Forbes and a couple of different publications. Some we got into, some we didn't, but we pitched a whole bunch of different writers and editors on what we were doing, and definitely got some coverage. And I have to tell you, that led to really great leads that did end up investing. And what I often find is you need multiple touch points. So while I got them interested via the article, and now they're reaching out to me on LinkedIn or wherever, it still required follow-up. It still required conversations or them coming to a webinar from the platform or whatever it was to seal the deal. But it opened the conversation in a way that I wouldn't have otherwise reached them. And the last one was more your traditional marketing PR. So we did digital marketing on Facebook. To be honest, I don't think we had the right message to start, and it was okay that it wasn't great. We were getting returns, but it wasn't, it was kind of 1 for 1 rather than a 1 for 10, which is really what you kind of want.
Right.
And so some of that we recognized was just the stage we were at, the story we were telling. We were really early. This was back in 2018, so only 2 years into the market, and it did take time, but now digital marketing has become a very big part of our business. And I think we've started to figure out the messaging better and have created video content and things like that. And I would just say a really big part of this is making sure your message makes sense and you're creating a campaign that, starts with awareness and ends with conversion. And I think at the start, we're just kind of blasting people with all the same stuff and not really thinking through it more critically. But it definitely improved over time on that front.
Yeah, I mean, you could drive 1 million people to an offering page with bad copy, bad graphics, and doesn't matter how many people are going there, it's not going to convert, it's not going to hit your goals. It all starts with that messaging, that storyline. We map out a whole strategy to determine what's going to appear there, of course. But you say from beginning, to end, what type of investor sales cycle, lack of a better word around that, but investor sales cycle were you using? What type of timeline were you seeing audiences get there and invest a week to 3 weeks later? Was it more of a month to 3 months? What type of time frame did you see?
It's interesting because there's a lot of nurturing that goes into relationships with investors. And what you don't want to do, I think if you do a good job, you build a relationship rather than a transaction. And a lot of people make the mistake of just going for the transaction rather than the relationship. So one thing that I would really call out to individuals listening to this is to invest in your investors, give them good communications, reach out to them. If they reach out to you, respond to them. Even if you don't want to get into a whole discussion with them, at least respond to their emails or inquiries or whatever it may be. You really want to engage these folks because oftentimes what I've seen is that a repeat customer is worth a whole lot more than just a new customer, right? Or it's a lot cheaper than going after a new customer. And so for me, a lot of times I've seen, they'll put in a little sum. And probably my best story is someone put in $100, ended up meeting them at an event I was hosting. Weeks later, they were kind of following our story. They went to an event, ended up talking with them, ended up having a coffee with them, and they ended up putting in $25,000. So it went from 100 to 25,000. The 100 got them in the door and interested enough to show up to this event. And we were running the event as part of our, kind of raising capital strategy, was to have people come and listen live to what it is we were building. So nurture those relationships, because you never know those small sums of money. You see them come in and you just think it's another name, but actually that behind that name could be, a whole lot of dollars if you take care of them. So I would say getting a small check, 2 to 3 weeks. Getting the bigger check could take several months.
Yeah, and we're actually looking at the marketing funnel with the first investment being more mid-low funnel versus the end result. That second investment that you're pointing out, generally larger, often followed by advocacy, peer-to-peer marketing, ultimate form of marketing at that, strong influencer of investor behavior as a whole. So we worked on a Reg A Plus campaign, successful, over 7 million raised, and they would systematically increase minimum investors. They're about a $400 minimum to over 2,000. Saw some six-figure investments come through on the Reg A Plus campaign as part of those IR investor relation conversations. Like you said, it's all about the relationship. And as more trust was built, as more bond happened as a whole, the other side was far more comfortable and interested in being involved at a larger level. So not just playing for that transaction, such great advice. Being able to look at those timelines, few weeks, few months, I think is so important as well too. We'll often see misconceptions when launching with new issuers where they want to be live the next day after signing on with us. Day after that, they want to have results. So we try to paint the right picture. Even in terms of optimizations, we've had campaigns that have shown little to no results in the first 3 weeks, and by week 6, we're surpassing all performance benchmarks. And it's like you said, it's not just if you build it, they will come, or even just run marketing, it's going to work, as much as how to get that marketing to work for you. Were there any notable optimizations that you guys made? Was there anything that you guys shifted in your campaign and it made all the difference?
So I would say 2 things. One, in terms of some of the upfront marketing, we did move more to a video type of thing. And the video engagement seems to be higher than just doing photos. So that was really cool. It was a little explainer video, and it helped people understand very quickly what it is we do without having to, delve in too much. So I think that just helped drive awareness and get them engaged. Whereas before we were losing them before they even became engaged. So that was one thing, was creating an explainer video. That seemed to really work well. And then the other thing, though, was getting people through that funnel to the awareness and following us on Start Engine, on Net Capital, and then being very diligent about updates. Updates turned out to be, it was really fun. I remember on Start Engine, I would just create an update about, we're at this conference and we're doing this thing, and you'd see a couple thousand come in like minutes later, and then we're doing this, and just explaining the process of our building of the company over the few months we were live. And every time we put out kind of a new thing about what we were up to, and we hit those people who were following but weren't investing, suddenly they were investing because they saw us being active. And so updates for me have been a huge thing.
Yeah, investors want to do their due diligence. And if they see active social channels, active blog, active updates on the portal itself, or an email that they sign up for, we've seen that reflect in a higher conversion rate across the board, at least as a rule of thumb. So try to always apply those best practices. What about scaling? We're talking about the increase of 1.07 million on Reg CF deals from accredited and unaccredited investors. Let's say a issuer hits 1.07 million in February and the extension becomes active. What do they do to scale from there? What would be the recommendations based on your own experiences and your own research for them to hit a critical mass and be one of the first issuers to hit 5 million?
Yeah, it'll be really interesting to see. So I think that does come down to a few things. First off, PR marketing strategy has to be in place. You're going to want it. If you do marketing well, and I've talked with a few issuers who have really succeeded with their marketing. And I was talking to one issuer several weeks back, and he was explaining to me that he knew exactly what his customer acquisition cost was, or his investor acquisition cost was, and he knew how much ROI he got for that. He's like, every dollar I put in, I get $9. So he's like, I am going to do an A+ and scale up those dollars to reach that. And he was just explaining how he thought about it very mathematically and came up with, here's my ROI conversion. I just need to invest these dollars, get those dollars. And I was really impressed by his thinking around, how to do marketing at scale. But it's starting with small numbers, figuring out your ROI and conversion rates, and then scaling up that dollar spend. So that is part of it. And taking part of that raise and recognizing that, hey, I've raised $1 million. I'm going to take 100 of that to help me get to the 5 million. But recognize that you get a good ROI out of that. The other thing is a PR strategy. It's putting your story out there. I mean, look at a Nightscope, right? They have done an incredible job. They have commercials. They've been on TV. Every time I see them on TV, I'm always blown away because I got to know the Nightscope team, several years ago when they were starting out early on, and to see them having so much success and now turning to things like television and using bigger forms of publishing and getting out there, because bigger dollars require a larger audience and a larger top of funnel. So I think we're going to have to innovate on the practices we've had and go from just digital marketing to think about doing things like that, and using YouTube ads and using TV ads and doing larger sponsorships. I do think that'll be a part of it. And then lastly, it is going back to this investment in your current investor base. I would say of the $1.5 million we've raised, 750 has come from a new investor, 750 has come from a recurring investor. And so it's just so important to lean on them and help you continue to accelerate the investments going into your deal.
Yes. And when you talk about PR, what do you think about some of the new endorsements that are happening in the industry? You mentioned Start Engine. I believe we first met at the Start Engine conference a couple years back. Bringing in Shark Tank personalities, angels and entrepreneurs, taking similar routes. What do you think that is going to look like? How do you think that's going to reflect in the industry, and what other types of talent will be brought to the table in the coming years?
So if you think about the public equity space, you have the Gardeners over at the Motley Fool. You have all of these major publications like that excite people, that get them to take action. And something that I think is important to understand is that, with public equities and with private equities as well, getting people to take action is very, very hard. And everyone is trying to lean on someone else to kind of do the work for them. And frankly, it's the same thing in private equity, venture capital, right? You always hear about hype. And people seeing, Andreessen are a really big shop throwing in, and then they just want to get into the deal because they want to be a part of the hype and the excitement. And it basically lends credibility to that startup, right? And that's what drives people wanting to invest in that deal. Now, you have to be careful with that. 100% can lead to dangerous activities, and we need to be careful about what those endorsements do. Clearly, they do drive engagement, though, and they do drive people to take action. Because if someone like, Kevin O'Leary on Shark Tank is recommending a deal or saying, I endorse this deal, it sends a signal to an investor of like, here's someone that's smart, who's been successful, who's investing in this deal. And it just gets people excited. And I get that. And part of this whole investing thing is it being fun, right? There's that element to it. And so I do think it drives action. I do think it helps to bring way more awareness and eyeballs on the deal than would otherwise be there. And I think we'll see continued growth because frankly, it's working, right? Start Engine is doing really, really well. And it is in part to Kevin O'Leary. And there are some other notable names out there that are getting into the space. And they do an exceptional job of driving excitement. Unfortunately, I do think a lot of them are actually doing a lot of due diligence before they make those recommendations and say the things that they say, which is great. I'm really glad to see that. I think everyone to date, from what I have seen, has been very responsible. But I just, always remind investors, while it's very exciting and it's definitely going to help, move the ball forward for the industry, just always do your own due diligence too, and make sure you believe in it. You're not just believing in them believing in it. And part of that, is utilizing something like KingsCrowd. It's not to toot our own horn, but going and doing your diligence and thinking about the valuation and the founding team and the market opportunity and making sure you're doing your own analysis and feel really good about the fundamentals. If both of those things align, then I think it's a win-win. But just make sure you feel good about it before making that investment.
Great recommendations. And speaking to analytics further, speaking to KingsCrowd and any audience that's browsing on your platform, do you see any trends in terms of the deals that are most successful, be it their valuation, their vertical, existing audience size, any other types of elements of their product or company or team? Are there constant trends that you almost want to, alert the industry of? This is what you need to look at. This is what we're seeing as success factors.
Yeah, so it's kind of cool. I think so we see a lot of Y Combinator 500 startup type companies come on these platforms.
Okay.
And one of the things about it is if you already have credibility from a notable investor like Y Combinator 500 startup, it sends a huge signal to the market. People love those types of deals. So that's one thing. Do you have some sort of credible investor that's already come into the deal? The other thing is valuation wise, the average we see in the industry is around 12 million. So in Reg CF during 2020, on average, companies are raising at the 12 million price point. And most people are utilizing Reg CF for pre-seed seed deals. As we begin to add in more of that Series A, that might creep up to 15, 20 million plus. But right now it's around 12. So if you're a pre-seed and seed startup, going above 12 is going to be a little bit demanding. Going below 12, somewhere between 5 and 12 is your perfect band. That's where we see people have the most amount of success, and it opens up the least amount of can of worms that you have to answer for. So
Sure.
being in that band is really, really good. Technology is obviously very hot. Inclusive teams is really on the rise. So having female founders, minority founders on the team at a good valuation in technology is like a real premium place to be if you're a company trying to raise capital in this market. And it should send a signal to even more Y Combinator, 500 startups and Techstar type companies that this is a really good place to be, because people are going to love your story because you are technology, you have a credible investor, and you can price yourself somewhere in that 10 to 12 million valuation range as a seed stage company. And I think those factors typically are best for doing really well.
Those are definitely overlapping with ours as well too. And female founder, Black owned, Black CEO, all different types of accelerator and different types of VC backed groups we've seen do particularly well. We know some of the platforms have restrictions on which Reg CF and Reg D platform, Reg D deals they take on that reflect exactly what you just said there. And want to ask about industry. I see it across the board. I see it more of what's new, emerging at that point. But are there any verticals that stand out to you? Be it energy, automated retail, various types of electric vehicles, or any type of tech or vertical that you would definitely encourage to look at equity crowdfunding if they have not yet?
Yeah, one thing that I think people thought was that B2B software, for instance, would be something that people in the equity crowdfunding space wouldn't engage with and wouldn't invest in. And that couldn't be further from the truth. If you have B2B SaaS tools, go and raise money on these platforms. That is one sector that I heard a lot of naysayers and I've seen a lot of success. And I think it's because there's a lot of fodder out there about the fact that B2B SaaS companies become extremely successful and make a lot of money. And I think enough people have heard those trend lines and seen the snowflakes of the world do extremely well, where people want to be a part of those types of deals. So B2B SaaS has done very, very well. FinTech has done very well. I think it has to do with the fact that the type of investor who is in this market today, the early adopter, is a FinTech enthusiast because they're utilizing platforms like these. So FinTech deals seem to do very, very well. And then consumer brands. So Shark Tank companies come on all the time, whether they got a deal with the Sharks or they didn't get a deal with the Sharks. We see a lot of them on WeFunder and Start Engine, and they do very well because they're compelling stories. And they're the type of thing that if you put a Facebook ad and it's a dad or a mom who utilizes the product. I'm thinking of like this funny sponge they have for kids in a sponge bath type of thing. And they raised a bunch of money, but it was because they had bought the product already, and now they're being told they could own a piece of the company, and they saw it on Shark Tank, and all of that was just a really compelling story. So consumer brands still do very, very well, I think, too. But B2B SaaS and FinTech, I think, are ones that kind of stand out. And I would say during COVID, the last one that's worth mentioning is healthcare, med tech type of stuff. There was one company, Elemento Health, that recently raised capital on Republic, and that one did really well. I believe the round sold out. Anything around kind of telemedicine or optimizing healthcare right now is definitely on the up and up as well.
All great points. What about KingsCrowd and how you guys feature deals? Is it strictly based on the analytics? I think it was mentioned on the Core Connects conference that if a group reaches out to you guys, it actually goes further down in the list. I mean, what about PR around KingsCrowd for a founder who's launching one of these platforms? Do you have any recommendations for them?
We're certainly not a PR platform, and it's really not our style or how we work. So our whole thing is to bring an independent, unbiased voice into this market. And one of the other kind of long-term theses we have is that if we take a quantitative approach to looking at every one of these companies of which we have their financials, their terms, how much money they raise, if we take every one of those companies and we watch how they perform over time against all of our rating metrics, we could actually begin to build predictive analytics and perhaps be even better at investing in startups than a traditional investor would otherwise be just using qualitative factors, which has historically been the way startup investing is done. So we take a very systemized approach to looking at the entire universe. We want to be looking at every Reg CF as soon as a Form C is filed, we get the record pulled into our system, and then it begins the process of being reviewed. And we have founders reach out and say, hey, oftentimes we'll just send a note that we have a process, and if we're interested, we'll reach out. But we go about our own process, totally independent from the issuers, and really go through the process looking at over 170 data points. Our full-time investment analyst team, we have 6 people actually who look at these deals full-time, and they dig into these deals and they look at the financials and they look at the market opportunity. They do their own market sizing, do their own founder research, and all of that basically spits out a benchmark rating across 5 key components of the business and says, this is a really strong business based on these factors, or this is a business that has these weaknesses. So if you exist and you put up, a Reg CF offering on one of these platforms, it will be tracked automatically. Nothing needs to be done by the issuer in order to be covered. Like I said, we're not a PR platform. We're not a news platform. We're very, very much focused on being a comprehensive, independent rating platform.
And that integrity definitely shows. And like you said, you're able to cater to the investor, the portal, use those as vehicles to raise the industry as a whole. So definitely appreciate that background. Do you have recommendations for any founders listening today, based on your experience launching these campaigns itself? You've already given us some great ideas on how to test, on how to optimize, but any, completing recommendations on if they're planning to launch January 1st, what they should do, what they shouldn't do, timelines, anything along those lines based on successful campaigns you've seen? Yeah,
first off, plan on it being, a 3 to 4 month process in total from end to end. So it'll probably take you 4 to 6 weeks to get up and running, and then, 2 to 3 months live. Set reasonable expectations for yourselves. Think about what do you think you can actually circle up as a founder. And all of this is essentially getting to plan ahead. Think about who you want to target, who you're going to go after. What would the persona be of an investor that you would want to, go after? What are the marketing materials you'll need in place? And frankly, work with companies like yourself as you're planning to go on the platform. Also think about what service providers do I want to work with? What's my budget? How much do I want to spend? Really think through all of those things. And then once you kind of come up with that marketing budget and you make your plan, then you can start to think about, well, what do I need to bring to the deal? How much money do I need to find from my first person network in order to support the marketing efforts I'm putting in to accomplish my goals? And then be patient. So when you go live, it's not all going to happen on day one. There have been a few instances where people sell out in one day, and I would love to be them. For the vast majority of us more normal folk, that's not necessarily going to happen, and that's okay. Be patient, continue to invest, make the phone calls, put out the ads, keep doing your work, and I think eventually you'll get where you want to be as long as you're thoughtful about it and take the time to get it done right.
You're to hear. Follow that to a T. Based on all of the research and analysis on the background. Couldn't agree with that more. I wish that was just imprinted in some of the Reg C filing documents. So appreciate all those recommendations there. And Chris, this has been a wealth of information in a short period of time in this episode. If anybody wants to get in contact with you, do you have a preferred method of communication? Do you have anywhere to point them to?
Just email me at chris@kingscrowd.com, or you could go to the kingscrowd.com website, find our kind of help email. But definitely reach out. We always love chatting and learning more and helping people understand the space. That I'm willing to do at length. So please do reach out.
Yes. And in case Chris hasn't mentioned enough, he's downplaying such how important of the role KingsCrowd plays in the industry. They are the standard in terms of industry news, statistics, everything that's going on, and as all these different more institutional groups are getting involved. So Chris, thanks again for being here. Such valuable, actionable insights. Appreciate the time.
It's been a pleasure. Thanks so much and have a wonderful holiday.
All right. Thanks everyone. We'll see you next time.
Take care now.